Good morning. This is Larry McMillan with the stock market update before the market opens on November 7th. So we had the FOMC meeting last week, and it provided the volatility that many people were looking for. And then Chairman Powell made some very negative comments, and the market took a pretty good drubbing for 2 days. This is very similar to what happened back in 1973-74. Back then, every time the Fed Chairman Arthur Burns would speak, the market would go down. In this particular situation right now, though, the bulls are really trying to put together another rally or extend the previous one, however you want to look at it. So the rally died out right around 3,900 last week. But then around 3,700, the support was found on Thursday and Friday. So those are the two short-term numbers. A close above 3,900 would be bullish. Below 3,900 would probably be very bearish. A more of a longer-term view on the upside, resistance is at the 200-day moving average, which is around 40.80. And the support is at the October lows right around 3,700. So it's very interesting to see how the indicators have tried to hold on to some of their buy signals. One of those is the equity-only put-call ratios. They have curled upwards after the big down day right after the Fed meeting, but they haven't set off a new sell signal yet, at least not according to the computer analysis programs that we use to analyze those charts. So right now they're tentatively still on a buy signal. They would solidify that buy signal if they were able to drop below their late October lows. In a similar manner, breadth had been positive, but then it went very negative on, again, the Fed post-Fed action and generated a couple of sell signals. However, with Friday's improvement in the market, those breadth signals could revert back to the buy side. So similarly, both indicators, equity only and breadth, are really kind of tentative right now. I wouldn't rely on either one of them until they can actually show sound direction. There's the number of new highs on the New York Stock Exchange is increasing modestly, but it still hasn't gotten high enough to generate a buy signal from that indicator. So that brings us to VIX. VIX is still continuing to decline. It really didn't go up much at all with the sell-off in the market last week. So the VIX spike peak buy signal is still in effect. And also the VIX trend of VIX sell signal was canceled out, again by VIX being this low. So right now VIX is probably a little more positive than the other indicators, especially if you throw in the construct of volatility derivatives, where the term structure of the VIX future slopes upwards. So all in all, it does look like the bulls still have another chance to regain their footing, but they probably need to do it right away. And as I said, that level, the support level at 3,700 would be very important in that regard. Meanwhile, I invite you to visit our website, take a look at our daily letters where we stay up on top of these things. Well, I wouldn't say minute to minute, but day to day. And also, if you're interested, we are doing a webinar for Metastock this week, so you might check out their website for details on that, or you probably would receive some information from us as well if you're on our updater list. Meanwhile, have a great week trading.